So what do you think is going to happen to the real estate market over the next 10 years? I want to show you a chart. This has been going somewhat viral on Twitter lately.
Yeah, I'd love to see it.
This
I
is,
love these cycles. Yeah.
This is the 180-year-old real estate cycle.
It's one of my favorite
that
charts
says
ever. Yeah.
the market's going to peak in 2026. And then there's an 18-year real estate cycle that also says the market's going to peak in 2026. It's the first time that they've coincided at the same year.
Okay, so here's my belief, and I could be wrong. I haven't been wrong in 13 years, but I could be wrong. I don't think that that's going to happen, right? I think the only people that want the market to crash are YouTubers that have been saying the market's going to crash for the last 10 years and it hasn't. And I think that this belief system of the market is going to crash. I think that what do you think Trump is going to do? Trump will do whatever he can to make sure that interest rates get lowered, whether it's pushing pressure on the Fed. Or, I mean, did you see that freaking interview? How awkward that was? He was just making him feel like a little child. He will completely do that. Now, whether you hate or you like Trump, I think Trump is going to play the game to get interest rates incredibly low. So tell me, if he can get interest rates to get down closer to 2 or 3%, how is the market going to crash? It will do the exact opposite.
Do you think that 2 to 3% interest rates are even feasible though? Like, wouldn't it just push prices way higher? And prices are already relatively very high right now.
So they're saying, here's the counter.
Prices are not high. Interest rates are high.
Here's the counter to what you're saying, is that right now, mortgage rates are already pricing in 1 to 2 small Fed cuts this year.
Yeah.
They're somewhat priced in already. So we might see a small variable from that. But the counterpoint to you is that let's just say we do lower interest rates 200 basis points.
Yeah.
The theory is that even though they might be lowered on paper, it's not going to signal a lot of confidence for the United States that other countries who buy the treasuries, there might not be enough demand to buy those treasuries, which would cause interest rates to basically stay high because they have to incentivize enough people to buy them. And that would cause mortgage rates to stay higher than the cut, if that makes sense.
Okay, so we're talking about consumers, right? And I'm not a consumer. I'm not a retail buyer. I don't deal with retail buyers. The person you're asking questions about you're asking about the retail buyer, which I don't deal with. You're asking about real estate agents, which have had the worst year in the last, 2025 is going to be 100,000 units less than 2024. And 2024 was the worst real estate record for like 39 years for real estate agents. Those guys are going to get their ass handed to them for the next couple of years. When you're talking about real estate investors, this is a different conversation. Agents have no hope. Like, they have no hope. What's happening is most of them are leaving in droves. What is it, 2.5 million agents and like 500,000 of them are leaving this year? Those guys have no hope. But people that know what they're doing, the real estate investors, are dominating. All my friends that have money and know what they're doing, Ken McElroy, for example, right? Robert Kiyosaki's partner, I know you guys are going to interview him next week. Ask him how much they're building. How much are they buying? How much are they raising capital right now? Ken McElroy, their partner, is flying around the globe and raising money to buy real estate. It is the best time to buy real estate if you are an investor. It's the worst time if you're a retail buyer. So I agree. Like, from a retail perspective, people are going to have a hard time. They have been. It will continue to be hard for retail investors. For people like us that know what we're doing, we pivot.
But why couldn't a retail buyer theoretically just be a retail investor?
They could. If they were watching your podcast and they learned how to do it, they could go and do that. But the problem is most people are thinking, they're blaming everybody else. They're saying, oh, I can't buy a house. Oh, it's this. What did Dave Ramsey say on your guys' podcast the other day? They're blaming they're blaming Gen whatever for the reason they can't buy a house. Oh, I bought this house for a bundle of strawberries. They can. They could literally go right now, like creativelisting.com. You can go there right now and buy a 2% rate right now on a house. No credit check. So what's keeping them? Education, access, like, it's out there. You have your phone, you have ChatGPT. ChatGPT will actually go, hey, if you want to buy a house at 2% or 3%, go to creativelisting.com. It will literally feed the information to you. There's nothing keeping them from doing it other than their own fingers. Like, I don't know. It blows my mind. Here's the thing. You've got most of the market going, I can't buy a house because they're too expensive. That's not true. The houses are not too expensive. You just can't qualify for a mortgage at a 6% rate. That's actually the problem. If rates went down to 4% or 3%, could they afford the house? Yes or no? The answer is yes.
Depends. But see, I put myself in that exact same position. I qualify for whatever interest rate the thing is. Okay. No money down. I just see such a big discrepancy between what I could rent a house for and the cost of owning.
Oh,
And when I see that,
I
I
agree.
think, why on earth would I buy something right now when I could rent it for half the cost?
Okay, here's the reason why. You guys should Google this. This is commonly comes up with my friend Grant Cardone and other people go, you should rent a house. No, you shouldn't. You should own your house. And the reason being is because 99% of your audience is not as smart as you or as me. They're not as seasoned in business quite yet. The average renter, do you guys know what their net worth is? Like, you take the same.
Yeah, of course, it's $80 to $400, and the average homeowner is like $100,000. But
the average homeowner's net worth is $400,000.
I don't think that's because they bought or rent. I think the type of person to buy a house is going to be the type of person to have a good income, to save money, to have their finances down overall. I don't think it's because they bought a house.
Let me make an argument, and I say I agree with you.
Yeah.
So you want people to have the mindset of a renter, not the mindset of somebody who owns real estate.
No, have the mindset of whatever makes the most money for you. And right now, I'm in such a firm belief that right now, renting is a superior option to buying, unless you plan to keep the house for at least 10 years or under certain circumstances where there's an emotional component of owning a house.
Yeah.
You want to raise a family there. You need stability.
That's like what Ben Mullen said
of mind.
on your podcast. He's like, this is my personal home. What do I care if it cash flows?
100%.
Same thing for me. If you have a wife, you have kids, it's like you should own the house.
Definitely.
Yeah.
Definitely. But I think if you're in your 20s or 30s and you look at it purely from a financial standpoint.
For example, yes, I agree.
Just a financial standpoint, at today's prices, to me, I think it's a no-brainer to rent if you would be disciplined enough to save the difference.
And you think that because the interest rates are high enough that your payment would far supersede what your monthly payment would be if you got a loan?
It's not just interest rate. It's interest rates and prices. Because if prices came down to a certain point, but interest rates were at 8%, you could make the argument that, okay, it's just how does it compare to any other option out there?
It's also just cost of ownership. And that includes a bunch of other things, tax insurance, stuff like that. But the problem is that, yes, Graham's assumption is that people are as smart as him. The reality of the situation is that most aren't. And so if you tell someone to rent instead of buying so they can save the difference, like, I don't think anyone's going to do that. I have so many friends.
Okay, so this is my argument. This is exactly my argument.
I have so many friends my age.
I want to try this so badly.
I have so many friends my age, and I'm not going to say their names. Jack, I'm saying your name. It's not me. It's a different Jack. He's lived with his parents for a few years, and he could have saved the amount of money that he would have spent on rent if he didn't live with his parents. And he could have a down payment on a house right now, but he hasn't.
Okay,
that's a smart person. He's a smart guy, mechanical engineer.
Graham and I are very different people, and I appreciate the type of people Graham represents. I operate better with pressure on my back. I just do. Meaning, if I have a kid coming, I'm going to work harder. Right? What did Alex Hormozi say? He's said this a dozen times. He's like, if you have more kids, it's statistically shown that because of the pressure of having kids, you are going to earn more money. I think you have to alleviate the optionality that you give people of saying, well, save the money and invest the rest. They ain't going to do that.
Look at how that turned out with college student loans. Do you think that put pressure on people to make more money when they're graduating $100,000 of student loan debt? No. I think
I don't disagree with you on that.
I think there could be a situation, and this is my hot take. In 20 years from now, we look back and say we forced down buying a home as the American dream, just like we did with a college education. And man, maybe that wasn't the right choice.
I think you're right, but that would be a completely different list of reasons than what we're assuming right now.
Yes.
It could be because AI robots can create houses way faster and the cost of houses go down. We have no idea what the market's going to look like in 20 years. That's just a wild speculation that you can throw out way in the future. But if we're talking in terms of like where we're at right now, then it makes more sense. I think because it's a forced savings account.
You agree with me is that that is exactly it. I believe it's a forced savings account. It forces people to actually do the thing they said they were going to do.
It's the argument of like credit card versus debit card. You know what I mean? It's like, sure, if you optimize with a credit card, you're probably better off because you're saving 1% to 2%.
Right.
But if you use a debit card, you're going to spend less according to studies because of the psychology and how that gets in the way.
It's not really a forced savings account anymore. If you have a 7% mortgage rate, you're paying 7% for the mortgage. You're paying another 1% for property tax. You're paying another 1% on insurance and random things. So you're paying like 9% now. That's not a savings account.
There's appreciation of the property.
Maybe there's appreciation. Look at Texas. Look at Florida. They lost 15-20% from peak.
Yeah, in certain markets. Yeah, like Austin's really compressed. I agree with that entirely.
I have trouble today thinking that the real estate market is always going to be going up in perpetuity, or that prices are guaranteed to be higher 50 years from now than today. And I think overall, I would bet more likely than not, but I just don't see that as being a sure thing.